Hey y'all, should you get high? You probably should with the way inflation's going and these governments are being ran and all that stuff to deal with the madness. But seriously, that's not the point of the video. The point of the video is should you get high the ETF from Simplify? Dang, I'm rhyming again. Didn't even mean to. Um, this is going to be a real high level overview of high, simply because high is an extremely simple ETF. I did a video back when it first came out, and I said I would just wait and see. And I've been looking at it again, and even though it's not for me, I think it's a great way to earn some income. And I'll tell you who I think this fits, and I'll tell you how I do have one little issue with it. It's minor, but it concerns the dividend, and we'll get to that towards the end. But for those that are interested in high, it's from Simplify ETFs, and it's called the Simplify Enhanced Income ETF. And essentially, they provide monthly income by selling short dated put or call spreads on the most liquid global equity and fixed income indices. Typically, they use TLT, which is the 20-year Treasury, or the SPX, which is the S&P 500. I can't find what they have going on currently. Apparently, they have no put options on right now, but it was just dividend date, so maybe something's not jiving yet. So basically, what they do is they buy T bills, Treasury bills, and then they sell credit spreads or call put or call spreads on either or both of those indices to generate an additional roughly 0.5% per month, which, if you're into options at all, you know is pretty simple to do. So that's why I say this is not a knock out of the park, super complicated vehicle. It's buy some treasury bills and let's look. T bill rates right now, roughly 5%. So they're currently, high is currently paying about 10%. So that's about right. You get about 5% from the T bills, get about another 5-6% from put or call spreads on TLT or SPX, and Bob's your uncle. You got a pretty decent income stream. Now you can do this yourself. Just buy T bills and go do some put spreads or call spreads. If you're not familiar with spreads, I don't have a video on spreads, but basically you sell a out of the money put or call and buy one a little bit lower. That when you buy one a little bit lower, it gives you a little bit of downside protection. You'll still have some loss in case of a crash or in case the market just explodes higher, but it caps your loss. Okay, so that's the advantage of a spread. Okay. They say it's a sophisticated option writing algorithm. I don't know how sophisticated it is. It's just, credit spreads. So it does have a little bit of a high expense ratio at 0.5%, but considering, they are managing option trades, it's probably not so bad. It currently trades about $25, and that's what I really wanted to see when it first came out. Was could it? Because if you're in T bills, right, your net asset value should really stay pretty stable, and it has. It's had some really weird spikes. Look, excuse me. It had some really weird spikes like intraday, which I do not understand at all. Although, and I really didn't dig deep enough to find out, what happened here. But I mean, it spiked up to $26, $27. Like, that's just weird. And it happened a couple of times, but smaller back in August. So I don't understand that. That's a big spike intraday. I don't understand that. So, it really should be just flat. That's what this thing should do. It should be flat, somewhat cash-like, as long as there's no big spike up in the market or a big spike down in the market. I'm talking big. It should not affect this fund very much. What else? It pays monthly, so it must be better, right? And that's really about it. I will talk about see here. Sorry to interrupt. As of 9/29, all they're in is the T-bills. That's it. So there's no. I guess maybe Monday, they're going to put on some spreads, I suppose. But as of right now, according to their website, as of yesterday, all they have are T-bills, and that's it. If you look back, like at their last one, they had some calls on TLT. They had a credit spread on SPX. More puts. I don't know whether these are bought, sold, or what, but mostly TLT and SPX, and very little, very tiny. It doesn't take much to generate that 0.5% that they're trying to target, but mostly all treasury bills. So should you get high? Possibly. I'm not going to judge you. Okay. But the one concern that I do have comes with the dividend. Okay. Now, I did say treasury bills should be pretty stable, right? And if you're buying treasury bills, your account should be pretty stable, right? Now, how are they? One thing that concerns me, and it's because I trade options, right? And this thing is paying 20 cents a month for the past 7 months, steady. I don't know how they do that. I've looked through the prospectus. I don't see that it's a managed dividend plan. It says it's supposed to pay out all its gains income monthly. They will. I shouldn't say that. Let me back that up. They will pay out a additional at the end of the year if they have to. But I have not had an option trade where I can generate the exact same amount of money each and every month. So what are they doing? I don't know. I don't find any weird commentary or anything that says we're going to keep it at 20 cents. And, because are they making more than 20 cents and just banking part of it? That's possible because they are sitting on a little bit of cash too. And just going to wait until the end of the year to pay out the rest. I don't know. That's the only thing that concerns me. Because it's unknown. That's all. I don't think 20 cents or the 10% yield that it's giving is out of the question at all. I think that's an extremely conservative estimate and fund that they're running. I really do. So it's not for me. Why? Because I don't have a retirement account and I don't need the income currently. If you have a retirement account, tax advantaged account, that you can, because all these T-bill note interest is pure interest. All the options income is pure short-term cap gains or income, ordinary income. So if you have a retirement account and you're sitting on cash, probably could buy some high. You could probably get high and boost your the income that is being generated. But if you only have taxable accounts like myself and you don't need the income, it's kind of, you might, everybody's different. So you might want to check out your tax situation. If having more ordinary income will bump you up into a tax bracket or into higher taxes, then maybe a taxable account is not for you, and maybe getting high is not for you. But if you have, like I said, a retirement account, tax advantaged account, I see no issues with getting high. So that's all I got for y'all. I worked like 6 days this week. I'm tired. My feet hurt. I got a root canal. And I barely decided to make this video, and hope y'all enjoy it. And we'll see y'all next week. Thanks. Bye-bye. I am not a financial advisor. The information contained in this video is for entertainment and informational purposes only. It is not intended to be investment advice. Please seek a licensed professional for any investment, tax, or legal advice. Thank you.